Okay. Hello, everyone. This is Bernard Yang. Welcome back to the Capital Market Development China and Asia, co-organized by ABF Yao, Tsinghua Wudao Co, NUS, and SET, and also the CUHK in Sartang and in Shenzhen, and of course, very importantly, the BFI. This one is going to be on how do firms withstand a global economic shock, just right on target, right on time for this one, evidence from within firm response. And our presenter is Slava. 25 minutes, and then our discussion is Kai Li from HSBC Business School, Peking University. So Slava, would you start, please?
Yes, thank you. Just a minute.
As he is preparing, let me just say that in starting this one, we have pre-picked the papers in the first two sessions, but afterwards, following the discussions and the suggestions by Zhiguo and Michael, etc., we are going to have open submission for papers for us to consider. And thank you very much for the attention. And ABF Yao and Tsinghua will send the announcement. We'll be working together on this one. Thank you.
Thank you, Bernard. Thanks for having me in this group. It's a really amazing opportunity to present this paper. As you see, it's very relevant. It's a joint work with Xiao Chen and Wei Zhang. And the main question is about global shocks and how companies respond to global shocks. So as you know, there is a large literature studying how companies respond to product market shocks. And most of the analysis is usually the firm level. There are some papers, but not many that look at within firm relocation of resources. In addition, there is a parallel literature that comes from macro and international trade that looks at shocks arising from government interventions. And several papers study effects of these interventions on firms, again, how they respond and what happens. So what we're going to do in this study is basically focus on internal within firm adjustments of various policies in response to such a global shock. And we will particularly focus on various sets of frictions, financial frictions, labor market frictions, and governance frictions, to see whether these frictions have an effect on how companies respond to these shocks. So just to give you an idea about the setting, we will be looking at relationship between Chinese economy and US economy in the following sense. We will have global shock that begins with China, and specifically we will study effects of 5-year plans in China. As you know, these plans are the highest level of policies that adopted in China. And basically, they set sectors of the economy that will be encouraged by government. And then we will show you that, first of all, these plans have effect on Chinese economy, but also, not surprisingly, we're going to see that some firms in US will be basically crowded out by these shocks. This is probably not a surprising result, but what will be, I believe, more novel and really interesting is that we're going to show you that these shocks created winners and losers in US. And specifically, we're going to show you that some industries, for example, industries who export to companies in China that are encouraged by the shock, or industries in US that buy products or import from encouraged industries in China, they're going to benefit from this shock. So when we think about US economy, we're going to show you that there are winners and losers as a result of this policy shock. We're going to show you how companies respond, what they do, how they change offshoring policies, how they change investment policies, and how, again, various financial and governance frictions are going to affect it. So on side of the frictions, we're going to study several sets of frictions. the first set of frictions is about financial constraints, and we will use the most commonly used proxies for financial constraints. For example, we'll look at companies that have public access to public markets in US, PE-sponsored companies, and various other measures of financial frictions. We'll look at labor market frictions in US, specifically at the level of unionization and right-to-work law. Just to give you a quick background, right-to-work law basically give employees choice whether to join a union or not. And when a state adopts a right-to-work law, basically it means that unions are weaker. So we're going to show you that it's going to have a significant effect on how US companies respond to that shock. Also, we're going to look then not just at within firm relocation of resources, but we'll also ask, okay, within firm, we are going to see capital moving from one establishment to another, but what happens at the firm level? And we're going to show there that firms that were prepositioned well to these global shocks actually are going to be not affected negatively at all. We're also going to see very interesting tensions between firms and shareholders. Particularly, one example of that is that we find that when companies have very good position into the shock, shareholders almost are not going to be negatively affected by them. However, we're going to see relocation of production to China. So there are interesting tensions on that dimension as well. Okay, let me dig into data. So one of, I think, strengths of this paper is that we have really granular data on both sides, both on the side of the Chinese economy, where we use China Industrial Enterprise Database, and US, where we work with census data. The key, again, is to have clear linkage between industries into countries. So we're going to see what industries are encouraged in China and what industries are affected in US at the same time. But also because we want to study within firm relocation of resources, we need to have data on establishments. And this is exactly what census gives us. We can track investments, employment, closures of establishments in US. And we're going to leverage all the beautiful things that come with census. Both databases, they're not self-reported, they're mandatory and comprehensive government software. So data quality is really high and reliable. In addition, in some of tests, we're going to look at what happens at job postings in US. This is where we use burning glass data that covers 2007 and then 2010 to 2020. As you see, for establishment level data for China in US, we have sample that starts in 1998 and ends 2013, 2016. So it's quite long sample of firms. So we merge again two databases, and we have about 1.6 unique business establishments in US and 1.1 million firms in China. When we study analysis of these 5-year plans, we'll identify industries that are affected. On average, industries are large. As you can imagine, in US, industries include about 600 establishments, and on the Chinese side, about 1,500 firms, and employ between 100 and 600,000 people, again, on US and Chinese side. Wages in US are comparable to other studies. For average employee, it's about $55,000. Okay, now on Chinese end, we also have data on subsidies that companies receive. These are only subsidies such as tax rebates, financial aids, and R&D grants. So there are, of course, many direct subsidies that we cannot capture. We do not study anything on the US side. So again, the key idea here is to look at 5-year plans to identify encouraged industries in China. And then from there, almost all analysis will be on the US side. We'll see how affected establishments respond, how establishments that export and import to corresponding industries in China respond. So most of the analysis will be on US side. And by that, we don't mean to say, of course, that US is not responding to these shocks. US, of course, also has government policies. We just do not study it in this paper. Okay, so again, quick background, what are 5-year plans? This is basically the highest level, again, of central government's industrial policies. These plans identify industries that will be encouraged. 5-year plan started in 1953. We know that it's not unique to China. There are other countries have followed same policies as well. 5-year plans are not new to research. People have studied it. Chen et al. Is one good example of that. So we will be able to look, because of our sample coverage, at the following plans. The 10th plan, which corresponds to 2001, then 2006, 11, and 16. This is the last plan that we can study because, again, census data ends relatively early in our sample. So this table just validates that our measurement of encouraged industry is reasonable. On the left-hand side here, you see as dependent variable log of number of firms in China and log of number of employees in China. The analysis here is at industry level, and treated equals 1 if industry is included in the 5-year plan as encouraged industry. And again, to validate basically the first step in the shock that we're going to study, we see indeed that when industries are included in the 5-year plan, both number of firms in China and employment in China go up. Not surprisingly again. But then the key of this paper is to go to the other side of the planet, to go to US economy and see what is going on there. This table probably is also not surprising, but it's a good validation of what we are measuring here. Here we show that industries in US for which we see encouraged industries in China, these industries are crowded out, which is again as expected. We see reduction in employment, reduction in investments, and higher likelihood of closures for these establishments. Economic magnitudes are non-trivial. We see about 5 to 6% drop in employment and investment. So again, we know that it's as expected because these industries compete, right? If industries in China are encouraged, industries in US are crowded out. Now begins the most interesting part, but before that I will show you a few figures that will hopefully make you feel more comfortable that we can talk about causal effects here. So first of all, I show you here dynamic effects on US. And again, as if you focus here on years before the plan, -3, -2, -1, you do not see any pre-existing trend in employment, establishments, and other outcomes on the US side. So it looks like US companies did not anticipate these shocks in the first place. We also look at stock market outcomes. Again, we see that valuations of affected firms in US eventually are negatively affected. But the key is, when we look at years before the shock, we do not see any trend. So it looks like financial markets could not predict which industries will be included in the 5-year plan, which is very comforting because we know that financial experts and the entire industry expended enormous resources in trying to predict these decisions. Yet we see in data there are no pre-existing trends. To give you a little bit more granular idea about the timing of the changes that happen on US side, when we focus in first 3 columns on employment, investment, and output, we see that negative effects start building, they become significant starting year 1 after plan adoption, and then they build up a little bit. Importantly, when we now look at number of establishments and closures, you see that the negative effect is delayed, which again is a very plausible timing of changes, because we see probably what is going on. Firms, first of all, start cutting production, but when they exhaust all possible intensive margin cuts, they go and start shutting down establishments. When we look, however, at stock market reaction and job postings, we see that these effects happen immediately when plans are adopted. So again, no pre-existing trends, but the response by stock market is almost immediate, meaning that people understand what will be happening. If industries on Chinese end are encouraged, probably it's going to be bad news for corresponding industries in US. So now I move to the core part of the paper, and we're going to see what happens within firm. So now again, we're going to take company and we're going to consider several establishments. Some of these establishments will be in treated industries, industries that are directly affected by the shock. Some of these establishments, however, will be in what we call beneficiary industries. Industries are going to benefit from that. And two clearest examples are industries that export to encourage industries in China. Why they're beneficiaries? Because they're selling the product to someone who is now going to get support from Chinese government. Another example is these are establishments that are downstream to the treated one, and they import from China. So again, they buy products from industries in China that are encouraged by the plan. As you see from this table, when we look at these two types of beneficiary establishments, actually we do not see any reduction in employment investments. As in opposite, we see significant increase in employment, significant increase in investments, and significantly lower chances of closures. So again, this is first piece of evidence that shows you that these shocks that originate from Chinese 5-year plans created winners and losers in US. Some industries were negatively affected, some industries were positively affected. So now I will show you kind of in one setting where we look at all industries together. Treated here is again one if establishment belongs to industry that is encouraged on the Chinese side. And then we have two dummy variables that capture beneficiary upstream and beneficiary downstream establishments. You see that for these industries, the effects are positive. Again, very different effect of the same shock on some establishments. Importantly, for non-beneficiary industry establishments that are not treated but also do not belong to industries that can benefit from that, we see no effects. Okay, nothing is going on there. Next, I'm going to give you a much more precise version of this result. Again, in this setting, in this table, we use all establishments that we have, treated and non-treated. We use all firms that we have in our sample. Now let me focus on a very slightly different sample. In this table, we show you results that come from a sample that includes only firms that do not have any directly treated establishment. So for these firms, there was no establishment that was directly affected in a negative way by the shock. However, these firms did have establishments that sell to encouraged industries in China, and these firms do have establishments that import from encouraged industries in China.
Just interruption for clarification, please, Slava.
Yes, please.
Do you have the aggregate economic effects? Given your sample, it seems that you can obtain that.
Well, you're talking about economic
impact on employment over. Yeah, do you have them?
Well, this analysis is on within firm reallocation of resources. Once I'm done with that, I'm going to focus on firm level outcomes, and this is where we can talk about aggregate effects. I will not give you aggregate numbers, but that analysis will be focused exactly on that, to understand what is the overall effect on companies in the US. Okay. So again, the key message from this table is that when we look at firms that were not negatively affected by the shock, we still find that some of their establishments were positively affected, because again, they sell to encouraged industries and they buy from encouraged industries in China. Now, how companies respond? One margin that I just showed you on the previous slide, they change investments and employment. This is another margin, offshoring activity. And we see that treated firms, again, treated firms, these are firms in column 1 and industries in year 2, we see that they basically shift their activity to Chinese economy. Now, later on, I will show you how this response depends on several frictions, and then it will be very interesting. But remember this basic result, which is, again, this result by itself is probably not that new. Okay, now let's go and talk about financial frictions. The first 3 frictions in this table that you see are about financial constraints, and the another 2 frictions are about labor frictions, again, related to unionization. And I show you 2 columns for employment and 2 columns for investments. Low friction column means friction is not binding. High friction means friction is binding. What do we see here? For financial frictions, we see that adjustment of beneficiary establishments are substantially larger and more aggressive when they're not financially constrained. So again, it basically tells you that having financial capacity before the shock ended up being very useful for these establishments because they could respond. And later on, you will see what happens to valuation and overall activity for these firms. When we look at human capital frictions, again, labor frictions, what do we find? We find, again, when labor frictions are high, effects are smaller. When labor frictions are weak in column 2 and 4, companies respond more aggressively. So again, labor frictions here, in some sense, were bad for these companies because they didn't let them respond to these shocks. But remember, these labor frictions are there in the first place to protect employees. But we see exactly those frictions prevent companies from increasing employee base, okay? Which is a very interesting result. Now, let's talk about, again, response in the sense of offshoring activity and foreign firm present at industry level. Financial constraints, labor market friction, and also governance friction, which is measured here using board tenure. The idea here is that younger boards probably less likely to be subject to various agency frictions and agency costs. We see that when frictions are weaker, companies respond to shock more aggressively. So again, low financial constraints mean that company will do more offshoring. And again, the second column here is very interesting. High right to work friction variable means that unions are weak. We see from column 2 that when unions in US are weak, the chances of offshoring are lower. So basically, this is a very interesting aspect of unionization here. Having unions ended up being negative, bad news for establishments in US. Because if you have unions, you do more offshoring. If you don't have unions, you keep your production in US and you do other within firm adjustments. So again, this is where I wanted to summarize the role of unions, but I just said that let me move on in the interest of time. So now, Bernard, this is back to a question. Now I'm going to show you a set of results at the firm level. So now I'm asking question, okay, we know that within firm, there are beneficiary establishments and negatively affected establishments. what happens at the firm level. And I will start from valuation, two measures of valuation, Tobin's Q and cumulative returns for the year. The first row shows you what happens for firms that are negatively affected by the shock. And we see negative results. Again, not surprising, valuation goes down. But then what do we see? We see that several factors mitigate that negative effect. For example, having a footprint in China mitigates a negative effect on valuation. Having establishments that are in beneficiary industries in US, again, exporting to encourage industries in China and importing from encouraged industries in China, it also mitigates the negative effect on valuation. Having lower governance frictions also mitigates a negative effect on valuation. Now let's talk about financial and labor frictions. Similar results. Row number 2 shows you that companies with non-binding financial constraint or less binding financial constraints almost perfectly undo the negative effect on valuation. Again, for these firms, for firms that are able to invest in adjustment of production activities, we do not see significant negative effect on valuation. Similar for labor unions. In column 3, we see significant positive effect on valuation if company has low unionization frictions relative to, again, companies that have strong unionization frictions. Results for cumulative abnormal returns go in the same direction, but they're not significant. And the same result for right to work states. So again, the main point of this table is that if companies were able to adjust, if frictions were not binding, we see that they were able almost entirely undo the negative effect of this global shock. Okay? So who was really negatively affected is the companies on the US side that were subject to various frictions, labor frictions, financial frictions, companies that cannot adjust. They are the main losers in these games, but many other establishments actually expanded production and were better off. Just let me quickly review what happens to investments. Again, very similar results. We see that present in China led to stronger effects on investment and employment in US. And again, probably because these companies were already halfway moving to China, and we see that dynamics of production became even more aggressive. However, companies that had establishments in beneficiary industries, they didn't cut production, didn't cut employment, didn't cut investment. So again, being in the right position on the US side was helpful. Similar again for frictions, we see that
maybe wrap up 3 minutes.
I need maybe 1 minute. I'm almost done.
Thank you.
Yes. So when we look at employment and investments, we look at financial constraints. Again, we find that firms with non-binding financial constraints almost didn't cut investment and employment on the US side when Chinese shock hit them. And again, this is already at the firm level, not establishment level. I think this is a good time to conclude. Again, in this paper, we studied 2 major economies that compete. And we use here shock that originates from China. And we study how companies in the US respond, how they change the allocation of production within the firm, and how various sets of frictions drive that response. Overall, we can see that when companies were able to respond and make adjustments, when frictions were not binding, there was almost no negative effect on shareholders of these companies in the US, and much weaker negative effects on as outputs. Thank you very much.
Well, thank you very much. Very interesting results, very interesting paper. And Professor Kai Li from HSBC Business School Peking University will be the discussions. Kai, please.
Yes, let me share my slides. Can you see my slides in full screen?
We can.
Okay, good. Thank you. Thank you for having me to participate in this prestigious platform. In the past 2-3 years, I have been an active consumer of this platform. Today, I'm very happy that I can finally contribute a little. Today, I'm going to discuss this very interesting paper, How Do Firms Withstand Global Economic Shock? Evidence from Within Firm Responses. Let me put our attention into the context. So the research question asked by this paper is how U.S. corporations respond to the competition from China. And by reading this paper, actually, it really motivated me to review the literature. And I see that actually there are a variety of literature which studies the impact of China shock for U.S. For instance, like the impact on U.S. labor market, the impact on U.S. domestic innovations, housing price, tax revenue, consumer price, migration, the list can go on and on. And this paper actually takes a very special perspective, which is to study the within firm internal resource allocations by exploiting like very granular census-based plant level data. And also it utilizes the China shocks, which as a manifestation of 5-year plans in a staggered manner. And the main finding of this paper is that this paper actually documents there is a very novel within firm adjustment channel to the global shocks. Here is a summary of some of the key messages. For instance, we find that industrial policies actually display plants in US which belongs to the same industry due to the competition. But somehow the shocks triggered by these 5-year plans actually are not anticipated by the US firms as well as the stock market. And upon the shocks, actually firms make within firm adjustment towards those plants who are located in the beneficiary industries, for instance, in the either upstream or downstream, okay? And the paper also finds that such adjustment actually effectively make the firms to be more resilient to the competition shock imposed by China. Here's my assessment as well as my discussion plan. So my assessment is that this is really a very important and interesting paper. It documents a novel within firm resource allocation channel. And it has very strong policy implications. Like Slava mentioned that, for instance, we can understand what is overall welfare implication of the allocation within the firm. And also if government impose some policies which can alleviate the frictions like financial frictions, labor frictions, which motivate such resource allocation, it will make the economy to be better off. My discussion plan is going to mainly focusing on answering 3 questions. Namely, why do we study the internal resource allocation? Why do we use China's 5-year plan as a shock? And how to identify within firm allocations? And what is the pros and cons of the current identification scheme? Okay, of course, if time allows, I'm also going to share some other considerations. Regarding to the first question, I mainly would like to make some suggestions how the authors can position the key contribution of the paper. Regarding to the second question, I'm going to discuss some potential caveat of using this China shock. And regarding to the third question, I also would like to point out some potential caveats of the current identification scheme, which will lead for our careful interpretations of the result. Let me start from the first one. Why do we study the internal resource allocation? Okay, and I think if we view this paper very seriously, there are various ways that this paper can contribute to the literature. For instance, one way it can contribute is this paper empirically proves the existence of a within-firm channel in response to a global shock. Secondly, as Bernard just mentioned, okay, this paper could also potentially help to quantify how much is going to be the resilience effect, both at the micro and the macro level, and also the corresponding policy implications. Then it makes me to think which one should be regarded as a main contribution. My personal view is that it is the latter one, but of course, in order to establish this one, more work is needed. I would like to bring your attention to this paper, GM 2015. Actually, this paper, the authors document that there is a within-firm resource allocation upon a positive shock to investment opportunities at one of the plant belongs to the firm, okay? And it used the introduction of the new airline routes as an exogenous shock to proxy for the increasing of the productivity as well as the investment opportunity at the one plant. And therefore, the general message of this previous paper is that actually the within-firm adjustment is somewhat anticipated in response to all different kinds of major shocks. Okay, and if we view this piece of work in this way, then the current paper is just confirm this expectation with a particular form of shock, which is the global shock from China. Okay, and we know that the global shock is more significant event than the airline route changes, and therefore I think the observed effect is largely anticipated. And therefore, how can we further enhance the marginal contribution of this paper? I think it lies to the latter point, in which we can connect to the important literature which studies the overall effect of the China's import competition on, for instance, like the employment, investment, income, and so on and so forth. Okay, and in particular, this paper can complementary to the previous work because it can help us to quantify how large is the resilient effect from this internal resource allocation channel. How large is going to be the net gain between the beneficiary industries as compared with the losing industries, and explicitly accounting for this inter-firm resource allocation, will it change our understanding of the answers to the above big issue? But of course, a comprehensive answer to this question requires a rigorous identification of the channel as well as a very careful quantification of the magnitude of the effect. Second, I'm going to talk about why we use China's 5-year plan shocks. And here I would like to mention 3 potential caveats of using this shock, namely potential endogeneity and confounding factors, potential regime changes within the sample, and to what extent this shock is anticipated. And this paper utilized 4 events of the 5-year plan, ranging from 2001 to 2016. And what I would like to argue is that over this sample period, actually, China's industrial policies may be driven by or may correlated with some other confounding factors. For instance, it may reflect Chinese government's reactions to US-originated shocks, for instance, embargoes, trade wars, and the technical decoupling. For instance, consider the semiconductor industry as one of the preferred industry. Secondly, China's industrial policy may also factor in what are the industries in China which has a comparative advantage. For instance, like the labor-intensive manufacturing industry, like light textile industry. And it is also exactly these labor-intensive industries which create competition to the US. But at the same time, from the US side, actually, US domestically, these sectors are subject to their domestic shocks, which is related to the skill-biased technological change, which will confound the China shock. Secondly, I also would like to mention that there might be some regime changes in the competition structure within the sample period. In particular, the cutoff year might be 2012. Here I quote a figure by Octa. This is like a time series figure of China's share of the world export. As we can see that actually it roughly peaked at the year of 2012, which is particularly mentioned by the author et al. And before the 2012, actually China is in the regime that it was experiencing the export boom in order to fit into the global supply chain as a world factory. While after 2012, actually, this pace of fitting into the global supply chain is much slowed down. And on the other hand, actually, it incurs direct competition between US and China at the technological frontier. And if the regimes are different, then the underlying mechanism about the internal resource allocation might be different. Therefore, I think it would be very interesting and useful to study different regimes in different sample period. Lastly, I would like to also mention that much of the 5-year plan shocks may be expected to be anticipated. I have two reasons to mention this, because first reason is that it's a decision process of the 5-year plan. We know that the political bureau will discuss the recommendations ahead of time, and the people from different social strata will participate in the plan formulation. And also, at the same time, some of the industries, actually, they will repeatedly show up in the consecutive plans. And it is very intriguing to see the empirical evidence in this paper that there is no pre-response of the US companies or industries to all these announcement of these plans. Why it is intriguing? Because I feel that, for instance, for some of the industries which has been long in the consecutive plans, they should be anticipated and affect the pre-trends of these industries. And therefore, I think it is more reasonable to see some of the heterogeneous effect. For instance, some of the industries like electronic automobile industries and so on and so forth, maybe we can see some pre-trend. But for some other industries, maybe the pre-trend is weaker. And it is very helpful to see a summary table of the involvement of the preferred industries to help us to understand this. Okay, so my third comment is regarding to how to identify the within firm allocations. Here, I think the paper, the authors has a very interesting and a very cute identification. And I would like to, but also it involves quite intriguing understandings. So in order to help the audience to understand this, so let me dive a little bit deeper, okay? So essentially, in order to identify whether the firms in the beneficiary industries, plants in the beneficiary industries will be benefited from the demand shock, actually, the authors partition all the plants into 5 groups, G1, G2, all the way to G5. G1 is referring to those plants which is treated, meaning that they happens to be in the preferred industries by the 5-year plan. While the remaining G2 to G5 belongs to those plants who is not directly involved, itself is not directly involved into the preferred industry. But here, the authors further divided into 4 groups. For instance, G2 refers to those plants not only itself is not involved in the preferred treatment industry, but also these plants does not have any sibling plants which is also treated. While for the right-hand side, the same firm as treated. So this refers to those plants not directly involved by itself, but it has treated sibling plants. And for this part, it can be further decomposed into 3. One is with a sibling plant in the upstream, G3. G4 is with sibling plant in the downstream, while G5 is with sibling plant which has neither upstream or downstream, which is non-beneficiary. Okay, and once we have these 5 groups, then we run the above regressions. And what we care about is the coefficient delta 1 and delta 2. And the delta 1 and the delta 2 is with the reference group of the group 2 of the residual firms, which has zero relationship with any of the treated industries, whether it itself or its siblings. Okay, and the delta 1 and the delta 2 refers to the positive effect of those firms with sibling plant in upstream and downstream industries as compared with the reference group of number 2. Okay. However, I want to mention that up to this moment, this is still not the within firm channel yet. Why? Because essentially we are making comparisons across firm because of the fact that we didn't make a comparison within the firm by controlling firm level fixed effect. Here is the more refined version. Okay, so here the authors did two things. First, it eliminates the group of G1 from the sample, which is completely eliminates the treated group. Secondly, the authors run this regression by controlling this alpha JTP, which is referring to the firm year plan fixed effect. By introducing this fixed effect, effectively, now we are comparing at a particular year within the same firm, and we are comparing for such kind of scenario. If it happens that we have plants belongs to G3 and G4 as compared with the reference group of group 1 plus 5. Okay, so here I would like to mention that one thing which deserves a little bit careful interpretation is that now, as compared with regression equation 6, the reference group becomes different. Therefore, the interpretation of delta 1 and delta 2 will be different. Okay, so now let me focus on this regression equation and let me try to illustrate that there are several remaining caveats for this identification. First, I would like to emphasize that delta 1 and delta 2 larger than 0, may encompass two effects. One is the direct effect, which is even if there is no any active resource reshuffling, the fact that these G3 and G4 belongs to the manufacturing industries, and it will face the higher demand shock, and the delta 1 and the delta 2 will be positive, and this is representing a passive outcome of the shock. While there will also be the indirect effect in which if within firm there will be active reshuffle of the resources from the non-manufacturing plant to the manufacturing plant, then this is going to enhance the positiveness of delta 1 and delta 2. But I guess what the authors would like to identify is this active reshuffling channel rather than the first one, passive channel, right? So therefore, I think the identification here needs to be a little bit careful in terms of interpretation. Okay.
3 more minutes.
Okay. Secondly, what I would like to say is that maybe we should also consider to control for the local year fixed effect, because this will capture the local time varying patterns. Okay. So I would like to briefly mention that actually there is some recent advances in terms of econometric theory that the staggered treatment effect in the staggered DID may subject to some bias. I think it's helpful to correct such bias for the paper. Okay. So lastly, let me try to quickly wrap up some of the other considerations. I have several, but given the time, maybe I will only focus on the first two. The first one is emphasized a lot by the authors, which is regarding to the effect of the financial constraint. Okay, what I want to say is that theoretically it is not that clear. Why? Because the paper says that only constrained firm can afford the adjustment cost to switch to the beneficiary industry. But alternatively, for the constrained firm, actually, because they are limited in terms of resources, right? Therefore, they are expected to have even stronger desire to allocate a scarce resource to more productive plant. This is consistent with GM 2015 because they also find that the reallocation effect happens mainly for the financially constrained firm. So I think this paper suggests the first channel dominates, but it was for the further exploration. Last point, which I would like to mention, is that this the authors also has the last part to study the interaction effect of firm's adjustability on firm valuation. This adjustability can be whether the firm has a pre-position before the shock, whether the firm has a China presence before the shock. And what the authors find is that if a firm with adjustability, then the welfare implications will be perfectly mitigated because of the channel of the internal resource allocation. But what I would like to mention is that here the interpretation has to be a little bit careful. Why? Because adjustability at time year -1 may be endogenous, because it may be correlated with the firm's unobserved ability, risk capacity, financing conditions, and so on and so forth. Lastly, I also would like to mention that it would be very, very helpful to provide some like aggregate industry level evidence on the replacement, which is like mentioned by Bernard before, because I think this is corresponding to the like a more important contribution of the paper as the second point that I mentioned. Okay, I have some other considerations which I will like share with the author separately, but let me conclude. So this paper actually is a very important and interesting paper, and I mainly answered 3 questions in terms of this discussion, and I recommend everyone to read it very seriously. Thank you very much.
Thank you, Kai. Let me now pass the Q&A time to Michael for him to chair the session. As I explained earlier, I have a medical checkup appointment, and so I have my time constraint, and I anticipate that there will be a lot of good discussions. Michael, please take over. Thank you.
Yeah, thank you, Bernard. Let me take over. I would like to first thank Slava and Kai for the very informative and extremely interesting presentation discussion. Now let's take a few questions, and then Slava, you may actually think about how to reply to those issues. Since Bernie, since you will leave in a few minutes, so why don't we start with you if you have any questions?
Well, thank you very much. This is really very interesting paper, and thanks, Kai. Have a wonderful discussion. I have one very simple question. Is it possible to also look at the location effect on restriction? Because we know that the local government's policy may affect that too.
Okay, Zhubo, do you have anything to say?
One thing from the very beginning, very beginning, is this is on the most influential paper. I'm mostly just a consumer, but the David Otto's paper on this China shock affected on the labor side. What is different takeaway from here? Is it because of you might have some positive side of it? And I would say that if you guys wanted to say the positive side because the winner loser, maybe I think it will be useful to quantify that part. Because otherwise it's just very negative from the readings of this David Otto's famous paper.
By the way, Michael, may I chime in again? There's a lot of work on this now. In a way, this is in between labor and finance and also international economics, international trade. Recently, there's a series of papers, like, for example, by David Weinstein, and then in Hong Kong, Hui Tang and Chen Lin and so on. So it would be very useful to, when you do the conclusion, it would be very useful to link up all these papers for us to understand, like Zhubo just said, beyond just David and Gordon Hansen's paper, just put them all together so that we learn about the adjustment process, how the impact of this on for example, the U.S. labor and capital return and all this adjustment. And one more thing that I think is very important is that it's not about expectations that this will happen or not. It's about the lack of expectations on how fast, how rapid, how forcefully the Chinese growth is in all the planned industries.
Okay, good. So before taking more questions, I actually have a few more questions and comments. But Slava, why don't we stop here and ask you to respond to those issues first?
Thank you, Michael. Thanks, Kai, for amazing discussions and really good questions. Some questions are very relevant, and we will think about them. I don't think I want to do some questions I do want to address right away, because I think they're also related to what Jigua and Bernard were asking about. So what is, I think, the main difference from the literature? I think the way I see it is that this paper is focused on the role of internal capital markets, what happens within the firm, how it affects the response of the company to the global shock. Again, most of previous literature just looks at the direct effect. There is encouraged industry in China. There is a company that is negatively affected in the US. We show that if internal capital markets function well, if companies can make adjustments, conclusions actually are very different, right? We show that if there are existing frictions that don't let companies react, and here I need to address another question that was asked, then yes, effects are very negative. But if companies can respond quickly, if they can make adjustments, conclusions are actually very different from existing literature. Not only we do not see cuts at the firm level, we actually see some parts of the companies grow and become bigger and hire more people, right? So I think, to go out to your question, this is, I think, the main difference. We want to see how relocation of resources within firm affects our conclusions about the overall effect of the shock on the US side.
So suppose that my takeaway from that is certain skilled labor, like the labor, it's much harder for the labor to adjust. Is that fair to say? Like in terms of, suppose the firm can switch, but the suffering or labor part is still there.
Labor
or
part is still there, and I
view.
think, yes, exactly right. And we actually show it because we show that when labor is more constrained, when unions are strong, it becomes even more of a problem. For capital to adjust, and this is what there was the question on that as well, it's actually costly to adjust capital. You need to have financial resources to make capital adjustment. And I'm thankful for Kai for bringing it up. I think this is where we're different from GM paper. We're showing, again, this is our finding, that you need to have non-binding financial constraints to respond quickly, right? These adjustments are probably more expensive than adjustments that are studied by GM paper. And again, this is a very good reference. We will definitely dig deeper into that. Now, another, again, great question. Why this shock, right? I think we can agree that US and China economy is substantially big to study, right? It's big relative to airlines, opening the line or not. I think we just want to understand what happened here. Just from that point of view, I think it's substantially big and important. Another good aspect of that is, again, there is a planning process. Yes, there are discussions, I agree with you, and maybe there is some level of understanding what can be included, what cannot be included. Yet we see that stock market reacts when there is news about what industries will be included. So there is surprise component, right? There is surprise component. We see that valuation changes when decisions and final decisions are made. Investments on the US side and employment change when final decisions are made. So again, I agree with you. Nothing is perfectly identified. But the fact that things are very stable on the US side before these decisions are made, I think to me, it means that there is a substantial still surprise in the final decision. Okay. Now, again, there were very good questions about the aggregate effects, and I'm completely on board. And again, I think we will work on that. I think one of key messages of the paper is maybe we actually want to know aggregate effects, but we also want to open the black box and see what happens within the company. What establishments are losers, what establishments are winners, and how frictions that we study in theoretical papers drive this response. So again, I think we will do both. Fortunately, we don't need to make any choices there. I think I will stop probably now and take more questions.
Yes, good. So let me ask two things. It's more like a common set of questions. The first is both of them are closely related to Kai's discussion. So one is how do we think about the nature of the 5-year plans? Is that so? One way to think about it, a very popular way to think about it, of course, it's Chinese government's great initiative. They're able to identify a few industries with a lot of potentials, and then encourage resources to go to those industries. Another view is what Kai said, that it's basically a reflection of China's rapidly changing comparative advantage. So one thing I can think of is, I can come up with two counter examples to the first view. One is steel industry, for instance. You think about steel industry, when steel industry was included in 5-year plans, I think that your sample period actually covered one 5-year plan in which steel industry was included. And then later on, the central government just removed the steel industry. So, I mean, this is subtly different from what we typically think about what the 5-year plan does as industrial policy. You can think about the inclusion of exciting potential new industries. You can also think about dropping, those industries that are losing comparative advantage. And if you have, I think it's very easy for you to check the asymmetric effect. So most effects are coming from the inclusion of new industries, or coming from removing those old industries. So that will tell us more about the nature of the shock. And also, EV industry. Kai also mentioned the EV industry. EV industry was included, I think, about 15 years ago. But look at the first 5 years, and even the next 10 years, nothing actually happened. So that's why, I think it's not so obvious for me to think about, what should we think of 5-year plan. So that's the first question. But it's easy for you to do some robustness checks. And then the second is related to the ongoing discussion about your contribution to the literature. Author and his co-authors, I think, your reply makes perfect sense to me. If you think about the regional economy and versus a big firm, then I think what you're trying to say is think about the big firm as a sort of a local economy, and then you can identify the level of frictions for those firms. So then you can draw a comparison between your findings versus the typical findings in the literature. Think about why frictions matter for all these results. I think that makes perfect sense. But when it comes to financial friction, it's less clear to me. So my question is, typically larger firms, they have less financial frictions. And larger firms, whether or not larger firms are more nimble to adopt those adjustments, that sounds like a counterintuitive. Maybe, so you also document a lot of interesting channels through which firms are doing adjustment, like upstream, downstream. So my question is, maybe there are some compounding facts there. For instance, larger firms are less financial constrained, but they are also more diversified, which allows them to do quicker adjustments. And those small firms, more constrained firms, exactly, they didn't have much of these channels. So yeah, it's not entirely clear to me how to think about the differences. These are very long questions. I'm sorry for that, but I would love to hear your thoughts on that.
Thank you, Michael. So again, I think these are actually two long questions, but very good questions. First one, I agree with you. We can look at it. Right now, what we document is the fact of inclusion and exclusion from plan. So basically, if you're not included in the plan, then you're not treated. But I agree with you, we can look at industries that are dropped out. And maybe we can look at longer horizon, at least for some early plans in our sample, because for later plans, we just don't have the luxury of many years of the plan adoption. We can do it. I think the question on large firms is actually an excellent question, and it is going to be in the slightly revised version of our paper. We're going to have a few statements on what we call diversification idea, right? Because usually we think about this diversification as something that leads to discount and valuation, and we have negative association with that, right? That maybe these companies are not doing that well. One of findings of this paper is that it's actually good to have footprint in industries that are going to be encouraged by the plan, right? They ended up being able to respond to that and shift production there, right? Because if you're just a small company that is present only in one industry, your choice is basically only to shut down. You cannot reallocate your resources internally to different establishments in different industries. And as long as adjustment costs across firms are larger than within firms, our results actually imply that there is some positive role for diversification here in the sense that you described. It's good to have footprint in several industries. And I think it is very possible to think about internal adjustment costs being lower than external adjustment costs, right? If you think about two independent firms that operate in two industries, it will take a while for resources to move across two firms. One firm will need to shut down, right? One firm will need to be born, maybe. But if these two firms already exist under one roof, that adjustment can happen fairly soon and at low cost. And I think this is one of new findings of our paper. Thank you very much for asking. Again, I think it will be in the new draft. We definitely discussed it and we will emphasize it further.
Okay, so time is up. So let me thank everybody again, for participating in this very stimulating webinar, and also maybe dozens or even hundreds more audience sitting on 学说平台. Thank you all. And Bernard asked me to introduce the next webinar, but I searched very hard on the website and it couldn't find the next presentation. So Zhibo, do you know that?
I actually do not know either.
Right, so it's not
so
here.
I think,
One share.
Yeah. So for the next webinar, our speaker, Professor Hongling, has tentatively agreed. But
okay.
we haven't finalized the schedule with him yet. But we will make public announcement later. Yeah.
Great.
Okay.
It's
Good.
1 month later, right?
Yeah,
we keep the monthly frequency, right?
Yeah. Okay.
Yeah.
Okay.
Thank you all again. Bye-bye.
Bye.
Bye-bye. Bye-bye, everyone.